Welcome to the Australian Resources and Investment Podcast. I'm your host, Dylan Brown. Gold continues to lead investor focus this year amid global conflict and market uncertainty after its historic run in 2025 and in January 2026. To unpack the outlook for gold and the broader macro picture, I'm joined by Robin Tsui, APAC Gold Strategist at State Street Investment Management. Robin, thanks for taking the time to join me.
Thanks, Dylan. Thanks for having me.
Now, gold's had a dream run in 2025, just breaking record after record, and as we saw, broke its ultimate record of 5,500 US in January, but as of late, it's kind of been up and down. How do you see that? Is that due to the war, or is this more of a recorrection?
I mean, it has been a combination of factors. Gold prices has been extremely volatile in 2026. If we look at the analyzed volatility, it's around 26%, literally more than double of the average in the past probably 5 years. Now, in January, we did see gold price hitting records, and that's more due to the surge in geopolitics. I think Trump made a lot of announcement in January that supported gold prices in January. Even in February, we had quite a decent run. Until March, obviously the war in Iran. Recently, I think the last 2 months, gold has corrected around 15% in US dollar terms from the peak due to the rise in oil prices, the rise in inflation expectations. So in the short term, I think gold price has been quite capped in terms of, I think investors globally are expecting inflation globally, especially in the US, to rise. And that has a very short-term impact on gold, given the expectation of interest rate will be high for longer. But you're right, gold has been quite volatile. But at the same time, we do see some of the structural drivers over the long term that can support gold prices heading into the second half of 2026.
Your latest report talks about taco trades, which stands for Trump always chickens out, or nacho trades. What do those themes mean for gold investors?
Well, the taco, like Trump always chicken out, has been a trade probably for the past 1 or 2 years. It can be positive or negative for gold. What it means is that Trump always says the things that he doesn't do, potentially, bombing Iran, but he chickens out. So that trade or that theme has been quite positive for gold and equities in the past 1 year, because what he said, he's not doing it. So money keeps going into the equity market, even in the gold market in the past 1 or 2 years. Now, the recent theme or discussion has been the nacho trade, not a chance that Hermes will open. That trade has been quite negative for gold because I think the last 5 to 6 weeks we always hear about the situation will be improved, it will be open tomorrow, but then Iran will say we'll never discuss that with the US. So the nacho theme has been having quite a negative impact on gold, because if Hormuz doesn't really opens, that the oil prices will keep going up. So we saw the oil prices now is close to about 95 to 100 US per barrel. That's gone up about 20 to 30% since early March. As I said before, the higher oil prices will tend to increase inflation in the US. Increased inflation means that interest rate will be higher for longer. There has been discussion around even the US may hike rates in the second half this year. So usually the high interest rate environment, typically it's negative for gold prices because gold doesn't pay interest. So the opportunity cost of holding gold will tend to increase if the interest rate increases. So that's why this theme we talked about recently has been quite negative for gold. But hopefully, I think this morning, on the last couple of days, there has been some discussion around it will open eventually. That's why the oil prices have been declining, I think, in the last two trading sessions. So hopefully, if that situation improves, if oil prices do decline, let's say back to the 80s or even the 90s, gold price should be able to find its support in the next few months.
Yeah, I was just about to touch on because I did see this morning the price has gone up on those discussions on this more positive discussions of greater peace in the region. So I think investors, correct me if I'm wrong, if there's more positive outcomes out of the war, that gold will become because as we all know, it's been a safe haven. But I think, as you said, the oil price has impacted how they see investors see that at the moment. They're sort of stagnated a little bit. But yeah, what are your thoughts there?
I mean, historical oil prices rises should be beneficial for gold because it takes a lot of oil and energy to produce an ounce of gold. But we are in this situation where potentially there could be rate hikes in the US, which I think the market never priced in that 6 months ago. We did expect, even at State Street, we expect rate cuts two or three times, like in the second half this year. And I don't think that will happen now. Potentially the Fed will hold, but markets do expect interest rate may increase in the second half. So I think also because gold price has been rallying in the past 1 or 2 years, it gives investors an excuse to sell at the moment because last year, as you mentioned, gold price was up more than about 63% last year. This year is actually still up. Gold prices in US dollar terms is still up about 5%. But we are seeing that I think in the short term, there could be less flows into gold, including physical gold demand or even gold-backed ETFs. We've seen a slowdown since probably March. So the expectation of rate hikes, I think that's been the key reason why investors are holding off gold purchases at the moment. But as I mentioned again, gold prices is still up year to date. So it's been outperforming global bonds, US bonds. It's been outperforming the US dollar. Obviously, it's underperforming equities, but it's done its work in terms of outperforming all those less volatile, safe haven asset classes year to date.
Would you say that because it wasn't really a bit of a drop, would you say it was more some just panic sold? Do you think that might have been why?
We did see some, I wouldn't say panic, but probably more like short-term profit taking. Because gold prices in US dollar terms was up 30% alone in January. So I think at the end of January, we saw a dip in gold prices. We saw, I think, a lot of investors globally, they just profit took because gold price was hitting records. In March, I think it was both profit taking and also gold providing that liquidity buffer to investors. Because usually what we found is that when the global equity market corrects, usually there's more money coming out from the gold market to cover the marginal losses. We actually saw that in 2022 when Russia attacked Ukraine. The same situation happened. Oil prices spike, gold prices tanked at that time because at that time investors globally sold gold to cover for other losses in equities or even oil. So it's not uncommon when we see a correction in global market that gold price do tank at the same time. But what we found is that historically, every time gold price has been sold off, if you look at over the next probably 3 to 6 months, gold price can find its bottom. So I think a perfect example this year is that gold price only took, I think, around 3 weeks to find a bottom. So gold price did tank to about 4,000 US per ounce, but quite quickly rebounded back to 4,500. So literally 3 weeks, it found a bottom. But if we go back to 4 years ago when Russia-Ukraine war happened, gold price actually took 7 months to find a bottom. So within 7 months, gold price couldn't find a support to support what we call the supporting level. So you see that because in 2026, we actually saw a lot more structural drivers. So including the central bank purchases, including the theme of de-dollarisation, which in Asia is actually a theme that becoming quite highly discussed. So we are talking to a lot of central banks or asset owners, particularly in Asia, that they want to move some assets away from the US, potentially from the US bonds or treasury into gold. So all these themes, it never happened 4 years ago, but now we're all seeing these themes happening at the same time. So that's why we remain quite confident that or bullish over the long term that gold price will continue to rally. But of course, in the short term, it's going to be hugely impacted by the expectation of oil prices increases or decreases, or what the Fed will do in the second half of this year. Will they increase interest rate or put it on hold or even reduce interest rates? That's going to have a hugely impact on the gold price going forward.
Yeah, to one of my other questions about how closely tied the Fed cuts and Federal Reserve is tied to US dollar. I want to touch on the central banks. They've been buying gold a fair bit for years now. How important is that to the demand, and do you see that continuing?
In the last 3 years, central banks has ramped up the purchases. The reason being was back in 2022, the US sanctioned Russia. So Russia central banks could not use the US dollar. So since that incident or since that sanction, other central banks, including the PBOC, so the China central banks of Turkey, India, they're starting to move more money into gold because the risk of being sanctioned by the US, it could be true because they've done it to Russia. So that's why in the last few years, we've seen a ramp up of central bank purchases. In the first quarter of this year, we continue to see very strong purchases. So central banks in the first quarter of 2026, they purchased around 242 tons of gold. What that means is that, last year we saw about 850 tons of gold in the full year. So based on the 242 tons, we're still seeing that central banks are buying heaps of gold. Because compared to last year, 850, it represents about 28% of last year's demand. And considering gold prices in the first quarter was trading average 4,800 tons, sorry, 4,800 US per ounce in the first quarter, it gives you a sense that despite the higher gold prices, central banks continue to buy. Now, at State Street, we do have conversation with central banks. I think the motives for central banks to buy is because historically, particularly the emerging market central banks, they have limited exposure in gold. So relatively to the Western central banks like the Fed, France, Italy, they have quite a limited exposure. So the reason being is that they want to diversify. They have huge exposure in fiat currency, including US dollar. They do want to move some assets into gold as a way to diversify. That's one of the key reasons why we expect central banks will continue to buy. And another theme that we've been highly discussed with central banks, particularly in Asia, is the theme of de-dollarisation. They believe that over the long term, potentially the US dollar might weaken going forward. So that could be due to the US fiscal policies that could depreciate the US dollar, the oversupply of fiat currency going forward. But the theme of de-dollarization is actually becoming a more concerning factor for central banks in the APAC or Asian region. So I think these two themes alone will be quite supportive to gold prices, particularly among, as I said, the emerging market central banks will expect them will continue to ramp up due to the low exposure in gold reserves.
100%. And if Asian markets are valuing it further supports the safe haven point of view. If they're buying more gold than US dollars, then yeah, that tells you everything. I just wanted to touch on, do you believe most global investors are still underexposed to gold, or has the trade become crowded after such a long stretch of a strong rally over such a stretch of a time?
Yeah, there's been a lot of discussion around, gold's too overcrowded, especially in January, where all this money went into precious metals, gold, silver, platinum. But what we found based on analysis, so we look at the global ETF assets over the global assets, so including bonds, stocks, and alternatives. This is the most transparent way to look at it because we can quite easily pull those data on a daily basis because ETF assets are very transparent. What we found is that globally, global investors only has around 3% in gold. Um, to us, I think that's still underinvest in gold because at State Street or even research done by the World Gold Council, we do encourage about 5 to 10% in a typical 60-40 portfolio. So if a client or investor have 60% exposure in global equities, 40% in the global fixed assets or fixed income, very typical for a client. We found that if they hold between 5 to 10% of gold, the Sharpe ratio of the portfolio, so the risk adjusted return, actually improves. So if you hold 10%, the risk adjusted return actually flatten out. So after 10%, the Sharpe ratio actually declines. So what that means is that if a client holds more than 10% in gold, if they hold a 60-40, they'd be better off putting that money into other asset classes. So for strategic allocations, the 5 to 10% actually improves the Sharpe ratios, but after 10%, he actually flattens out. So that's why there's a lot of literature that encourages 5 to 10%. And when we talk to clients about this research, they do tend to agree that they are still underinvest. I mean, there's still a lot of clients of ours, they have very limited exposure, especially the university endowments, the pensions, even the insurance companies. They have no exposure in gold because historically, gold it's not a attractive asset class for, let's say, insurance company because gold doesn't pay cash flows. But the theme we've been getting, I think, in the last 12 months has been they would like to look into gold as an asset class. Like recently, we had a university endowment in Singapore that invested in gold for the first time ever. And we've been having a lot more discussion around with university or pensions in Asia and also in Australia that potentially they might look into gold as a way to diversify. So that's why we do believe now currently investors are still underinvest, like that 3% allocation. But we do believe that going forward, investors would like to increase more, maybe from 0 to 3 or 3 to 5 or 5 to 10. So that's quite encouraging based on the discussion we have, not just in Asia, but globally, that investors of ours, they would like to increase more in gold.
Do you think with the rise of, say, Bitcoin and other, has that sort of taken this, I guess, the limelight as far as, say, for younger generations, they wouldn't even think about investing in gold. It's either sort of, yeah, Bitcoin or any of the other sort of ETFs or that sort of investment or property investment for the elder generations as well. Would I be correct in saying that?
Yeah, I think gold, because most clients will bucket gold as alternatives. So it's competing with Bitcoin or properties, private equities, private credit, even silver and platinum. A lot of clients were comparing silver with gold in January. But I think most clients do understand gold has a different risk and return profile. When Bitcoin was launched, they brand themselves as gold number two. But nowadays, we rarely hear about Bitcoin branding itself as gold number two because I think, especially in the last few years, Bitcoin hasn't done the work in terms of providing that safe haven status. Bitcoin, every time the global market crashes, Bitcoin do decline at the same time. So I think clients do now understand that we're not comparing apples to apples with Bitcoin and gold. I mean, we do encourage diversification. So State Street, we do have a Bitcoin ecosystem product. But I think what's important for the audience to understand is that you cannot replace gold with Bitcoin, because Bitcoin sensitivity to the global equity market is extremely high. So that's why if the equity market crashes, Bitcoin will tend to crash at the same time. So you can have Bitcoin as an asset class or even other alternatives, but it's very important that you have that 5 to 10% strategic allocation in gold. If you have a 60/40, even if you have a multi-asset portfolio, even if you have other alternatives based on our back testing, that 5 to 10% benchmark still holds for gold. So that's quite important for the audience to understand that gold cannot be replaced by other asset class. And that's the reason why central banks continue to ramp up. Central banks, they don't look into Bitcoin as a reserve assets. They don't look into silver or platinum. They only look into gold.
That tells you everything you need to know if they're just looking at gold. Looking into, I guess, the next few weeks or even to the rest of the year, where do you see gold going from here? What could drive it up? What could stagnate it? How do you see it sort of playing out?
Yes, I think gold's been holding up quite well considering the oil prices situation. It did tank to about 4,200, but now it's hovering around 4,005 and 4,006. So we do believe, the Iran oil situation will be improved, based on the latest news, that there could be a deal with the US and Iran. I think Trump, or even the US, they will need to solve the issue before summertime, or even before the midterm elections, because if this situation keeps dragging on until September, Trump midterm election could look quite ugly, because inflation in US, it's been spiking up. It's the highest in 3 or 4 years at the moment. So I think in the next few weeks, gold should be hovering between 4,005, 4,006. But in the second half, what we expect is that if oil prices do decline to, let's say, 80 to 90, if the Fed decides to hold or even reduce interest rates, so if they don't increase interest rate in the second half, which we don't believe, so State Street, we still believe we are quite in line with the market. It's either hold or reduce interest rate by one time. I think gold price could potentially hit back towards the 5,000 US per ounce, because fundamentally we still see very strong demand into gold. So ETF inflows globally are still positive. The physical gold demand are still very strong in the first quarter. So investors globally are still buying gold as a way to hold long term through the physical demand. Plus, usually in the second half in Q4, there are some seasonality in terms of gold demand and the strength of the gold prices. So in Q4, there'll be more demand into gold because from China, they're heading into Chinese New Year. There are more Indian weddings in the Q4 period, and also there should be more rebalancing closer to November and December. So we do expect potentially there could be more demand into investment through the ETFs. And then over the long term, we still expect the US dollar to be weakened going forward. So based on the historical strong inverse correlation, the weakening US dollar should be quite positive for gold prices in the second half of 2026.
Awesome. I guess we'll see what happens from there. But thank you, Robin, for taking the time to join me today. That was all for today's episode of Australian Resources and Investment Podcast. For more news, insights, and market coverage, head over to our website and LinkedIn. Until next time, stay sharp, stay informed, and stay ahead of the curve.